Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Oh man, property tax increases again. Homeowners insurance premiums are going up too. These are good. Bills from contractors, look at the hourly wage on that thing. Water, gas, electric. Well, this stuff's going through the roof. And finally, HOA fees. My goodness. What's a saver to do? Well, let's find out.
Welcome to the only show in the country dedicated to helping savers worry less about money. The Worry-Free Retirement with your host, nationally recognized retirement specialist and six-time author and fiduciary, Tony Walker.
Well, welcome, folks, to the Worry-Free Retirement. And yes, I am that little man in the sweater vest, Tony Walker. And today, before we get started, let me introduce to you in the studios, as always, helping to produce this show on May 21st, 2024, America's favorite financial sidekick, Mr. Aaron Orander, along with Louisville, Kentucky's most laid-back graphics artist, Mr. Derek Hudson. Now, I know we've already covered a little bit about the issue of housing cost in retirement, but I think this is such an important issue. And again, seeing as though generally housing costs are the biggest expenses that not only are in the first part of retirement, but well into the second half of life, and in fact, sometimes become the biggest predicament for expenses dealing with our aging process that we all go through. So because of that, we've got a bunch of articles to cover. I've got a great whiteboard segment coming up later. We're also going to be talking later on with our own Juanita Jackson and just talking about the number of distributions we send regularly through our Charles Schwab platform to our many clients who have housing expense issues. But before we get into the meat of the show, let me introduce to you my favorite son-in-law and favorite fiduciary. Come on in. There he is again, Mr. Trey Juergens. Good morning, Trey.
Yeah, good morning. Thanks for having me back again.
Oh, yeah, this has been fun. And I told you with this new podcast format, not only you would be on TV more regularly, but again, a lot of our staff. And we just appreciate your willingness to get on TV. You're doing a great job. I don't know, you seem to not be crazy about this, but you do a great job.
It's fine. I think it's cool for our clients and those watching to see more of our staff. That's really the bread and butter of Tony Walker Financial.
That's right. And then next week, we'll have my favorite nephew on West. Great show coming up next week, folks, as we really dive in to the investment world. And I know people might say, well, Tony, I thought you dealt with savers. I didn't know you dealt with investments. I mean, folks, we have over 2,400 accounts with Charles Schwab. That's our investment platform. And I think as of this date, what are we up to, about $265 million under management?
Correct right now.
It was interesting. We'll get into the housing thing in a minute, but I wanted to share this with you, and we'll talk more about it next week with Wes. But I didn't realize the average amount of assets under management with an independent like us, money manager, is less than $100 million.
Yeah, that transition from state registration over to SEC, that threshold is about $110 million. We crossed that back in 2022, which required us to now be registered under the SEC.
But were you aware that the majority of advisors, I figured most of them would be even way more than what we've got, but apparently at 265 or whatever, that's pretty high for an independent organization.
I'd say so.
Real proud of, Shannon Ross, who kind of kicked this off in 2017, resurrected the Schwab program. Obviously, Juanita, you'll be meeting later. Obviously, what you've done, Heather, Beth Wisman, Craig Davis. I'm just trying to think of all the people involved with Schwab. It's a lot of people now. We have Wes who have a touch on that program, and it's become a vital part of what we do here.
Yeah, it's really cool.
And in fact, you're going to see in a little while on the whiteboard, we're going to have that person A, person B later on, and how we use the Charles Schwab platform to pay off the house a little earlier. So that's kind of cool. All right, Trey, so picking things back up here, I don't even know where to start, really. You have done a great job between you, Aaron, Derek, and then Gina Tutwiler. I've tasked you all with the process, if you will, of finding articles. Let's try to pull those articles together and come up with a theme for the show. So kind of give me an idea of what you all have come up with.
Yeah, with our income planning and laying all this out for clients, one thing we've seen is just the rising cost of several things. One of those in particular is housing. And what we've really seen, property taxes, homeowners insurance, maintenance and repairs, utilities, HOA or condo fees. I mean, all these costs, I was so proud of this list, and I was like, well, that's really just every cost associated with housing. So when we boil it down, there's articles that back up each of these, but we're seeing it every day. When these clients come in and distributions that we send out, that flexibility of the Schwab platform that Juanita will talk about, we have so many distribution requests. A lot of those we can increase monthly just to give you a little bit more cash flow. That's why the flexibility that we have is so nice for our clients.
And I think people are surprised, our normal fee, unless they're huge accounts, and they can get a little cheaper than this. But, the 0.8% that we charge, which is well below the industry average, the amount of work that goes into that we never charge an extra fee for. And in fact, with Schwab, in almost 99% of the cases, there's never any transaction cost back to the client to get their money back to them.
Right. That's a huge thing. I mean, in retirement planning, one thing we can do is cut costs. With housing going up, one thing you could consider doing is making sure your fees on your investment accounts are going down. So very, very few times have we ever seen a client with lower fees than what we're able to provide, unless it's self-managed.
And I'm not to say that a lot of times, folks, we're ahead of the curve here, but I've been doing retirement planning so long. One of the things I started recommending, even thinking about 8 to 10 years ago, and I can remember even some clients were like, are you kidding me? But we'll cover this article, and that's renting. And again, by the way, folks, this is a serious topic. I'm not suggesting what we're going to say you need to run out and do. But, years ago, I used to tell people from a cash flow perspective, remember, retirement is about cash flow, folks. Sometimes I thought it might be cheaper just to rent, especially if you get into really further in that second half. This article came out in Investment News, and it literally says this: as home prices climb again, it's cheaper to rent in the largest metro areas. So your thoughts on that, Dre?
Well, it is interesting. I mean, obviously you can cut out property taxes, you can cut down on insurance. Maybe you have a renter's insurance policy, but two of the big ticket items are gone immediately. And as you always say, when there are bats in the attic, you don't have to worry about getting them out yourself. You call somebody and they take care of it.
Yeah, and that's speaking of a big category is maintenance. When we get into retirement planning and cash flow, one of the biggest dangers out there is somebody not having enough after-tax money and an air conditioner goes out, or a major windstorm damages something and they've got a high deductible. Again, folks, we're not saying you should rent. But, I mean, think about this, Trey. Yeah, if you're renting, if the air conditioner goes out, if the wind, blows off your roof or whatever the heck happens, like I said, it's somebody else's problem.
Yeah.
You don't have to come up with that money.
That's true.
So one more article I've got to cover, because this falls in with the gifting. This was an interesting article. Boomerang kids putting finances at risk for themselves and their parents. So let's define boomerang kid. What's a boomerang kid, Trey?
They go live off on their own, but all of a sudden they're back dwelling in the basement, as they say.
I know times are tight. Don't move back to save money. That's how we save money, with you out.
And folks, this is happening more and more. I just met with a client yesterday, and sometimes it's through nobody's fault of their own. They have an adult child, apparently had some drug issues. The child went through a divorce. This is an adult child, has a 7-year-old. So like the mom's like, well, I'm not going to let him live on the street. So she's taking him back in. Now, what's interesting is they're going to try to figure out a way for the young lady, because she's going to go back to school. Mm-hmm. She's doing fine, recovering well. I mean, it's a wonderful story, actually. But this kind of rocked the mom's world. The mom was going to retire in a couple of years. That ain't going to happen. She said, I'm probably going to have to work a little while longer. But speak to the fact of our clients and how much Saver clients do want to try to help their kids, especially if they get in these predicaments like the boomerang kids.
Right. A lot of our clients, I mean, family's everything. They're going to take care of their children. A lot of the time, grandchildren also. And I've been to the grocery a lot here lately with 3 kids of my own. And with Lacey, I mean, we know these costs are going up. So if you're bringing children and grandchildren back under the roof, your monthly costs are only going up.
And then we got to have some fun here, because this was maybe a week or two ago. I can't remember, but we did something on reverse mortgages. Do you remember that? I got to cover this. It isn't funny, but in the reverse mortgage ad, we featured Tom Selleck, and you may have seen this ad. It's actually a pretty good ad, but I thought, wonder why Tom Selleck is doing reverse mortgage ads. And I'm not sure if this is it, but I thought this was interesting. You sent me this when Blue Bloods went off the air, which Tom Selleck was on, right? I guess these are the reruns.
I think it was #1 show in the world for a while.
I think this is Derek's favorite show of all time.
He's a big Tom Selleck guy.
But anyway, they're interviewing Tom Selleck, and basically from this article, it sounds like his ranch, which he owns in Ventura County, he might have to sell. Did you see this?
I heard he didn't have enough mailbox money.
I think it was not enough mailbox money. So, Tom Selleck, you should have gotten with Tony Walker Financial several years ago when those Blue Bud royalties were coming in. So it just goes to show you, folks, that basically when you get into cash flow and retirement planning, this housing issue is a big deal. So here's what I would suggest right now. Won't you put this up full screen, Aaron? I would go to TonyWalkerFinancial.com, click on that Let's Get Started. Now, who would want to go there based on this? It would be anybody that's getting ready to retire. Trey, it might be anybody who has lost a spouse recently. This comes up a lot.
It does.
Somebody loses a spouse, and I don't want to be stereotypical, but a female, her and her husband live on 5 acres out here in Oldham County or something, he dies. She's not going to get on that zero turn. She's going to try to downsize. So basically, it might be that situation. It could be even a couple. We worked with a couple in their late 80s that recently moved into assisted living. Mm-hmm. What are they going to do with a house? Are there capital gains? All these things we can help with. So if that's you folks, if this has been a kind of a dilemma, or maybe your adult children and you're watching your parents go through this and having a tough time having these kind of conversations, I think it would behoove you again to go to TonyWalkerFinancial.com, click on that Let's Get Started. We can have a free appointment, a consultation, or if the internet's not your thing and you just want to call us 24/7, just give us a call at 877-499-9255.
Did you realize that if you have more than $250,000 in retirement assets, the government could tax as much as 40% of it when you go to take it out? And with current tax rates set to expire in 2025, the taxes you will owe on your 401k could climb even higher. Don't wait until 2025 to see how much Uncle Sam will take of your money. Get a game plan by logging on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com.
Hi, I'm Juanita Jackson, and I'm responsible for establishing all new accounts with Charles Schwab at our firm. Today, we're talking about home expenses and distributions that are related to those. I'd like to give you a few examples of how you might call us for help with distributions with home-related expenses. You may be interested in purchasing a new home or a vacation property. Retirement income can be used to qualify for a mortgage or possibly a bridge loan. The housing market's competitive right now, and we're seeing more bridge notes all the time. This could give you an edge on an accepted non-contingent offer. You can call us to start monthly recurring distributions and ask for a proof of funds letter for your lender. This provides evidence of your ability to pay for the home. We just need you to determine the amount that you need and the day each month you would like to receive the funds. We'll get it set up for you. If you're ready to do a kitchen remodel or you've had property damage due to a storm, you can call us to request what's called a one-time distribution to cover those expenses. If it's a large distribution, however, don't be surprised when we take a look at the income plan to assess the impact of this large withdrawal. We want to keep you on track. And if you're considering a major renovation, call us. We can make an appointment to discuss the project costs and review the income plan to ensure that you're still on track with your financial goals. Property tax time is another time when we may get a wave of calls from clients who want to replenish their emergency cash savings after making those property tax payments. Wes and Shannon can quickly raise cash and send the funds directly to your bank account. Maybe you're ready to pay off your mortgage. Likely we discussed this with you during the initial planning phase as your income plan was being developed. It might be possible to pay off the mortgage in the same year. Or TJ and Leanne in our tax planning department may have determined that it's more beneficial to spread that payoff out across 2 years. We'll process those distributions directly to your bank account and you can pay off your mortgage directly. If you've got questions about any of these distribution types or any other questions, please don't hesitate to call. We're here to help you.
There's a lot of misunderstanding and confusion about the hearts and minds of savers, what makes them tick financially, and what keeps them up at night. And nowhere is this more misunderstood by most in the financial world who try to approach retirement planning from the mind of an investor and not that of a saver. And possibly worse yet, not even understanding how to properly count the cost of what they are telling these savers to do when it comes to paying off their home in retirement. For instance, take a listen to this so-called retirement income expert telling savers why they should not take large sums of money
to pay off their homes.
Right? Many people want to pay off their mortgage in retirement. We want that money compounding as much as possible. A mortgage at 7% over 30 years, you end up paying a $500,000 mortgage. You'll pay $1.1 million over the 30 years. If you allow that $500,000 to compound at 5%, a lower rate than the mortgage, you end up with over $2.2 million, an extra $1 million available for you after 30 years in retirement.
So basically, and not trying to be condescending to this young man, but he is not understanding opportunity costs. So let's just go full screen and kind of explain what he's talking about. If you take the raw numbers, this is accurate what he said. If you had a 30-year mortgage at 7% interest, over the next 30 years, you would have actually effectively paid in to that mortgage. The cost is $1.2 million. Okay, great. Then he did a future value calculation. Let's go with that. That's $500,000 at 5%, which in around 30 years is going to be around $2.2 million. That is correct. Those numbers are correct, and that's why he says, yeah, don't pay off the home. Take the $500,000 and invest it. But there's a huge problem there because he is not accounting for what's called opportunity cost. Folks, you can't just run the numbers like that. You have to take the cost of the mortgage and quantify it at 5%. I know this is confusing, but you have to do it that way, which when you do that, now the cost of the mortgage is not 1.2, it's closer to 2.8 million when you factor in opportunity cost. So the theory of using a lump sum and assuming 5% goes out the window. The next thing he's not accounting for, and this is what savers don't like. Savers like guarantees. And when you think about it, when you have a 7% mortgage, that's a guaranteed cost. In other words, you're losing 7% per year for 30 years. This young man assumes you can make 5% guaranteed for 30 years on an investment, and that is not guaranteed. There's nothing out there that will guarantee that for 30 years. So it's just not an accurate way to calculate things. Now, there's a second issue, and that deals with, okay, Tony, what could I do? If I'm one of these savers and I want that home paid off, well, let's kind of walk over to the whiteboard and take a look at this instance. So in our example today, we're talking about person A, person B. Both of these are savers, and their objective is to pay off this home as quickly as possible. Now, in this example, based on their income, they're each in a 12% tax bracket. Again, the federal taxes are going to expire at the end of 2025, but for now, we'll assume they stay the same. This is really important as we think through taxes. In fact, as a retirement planning firm, this is all we do. We do the investing, we do the planning, but we also think through tax strategies like this, and it's very important to understand how these tax brackets work, especially if you're going to take money out of a tax-infested 401k plan to pay off a home. So we have person A, person B. Now, person A, we're going to go with a 5-year strategy, and you're going to see this in a minute, because person A says, Tony, I don't want to go over the 12% bracket in order to pay off the house. Whereas person B says, no, I want to get it paid off now. I don't care if I go into a higher tax bracket. So we're going to see the effects of this and how we can adjust this according to what the client might want to do. Now, person A, as you're going to see, I would rather see them do this, but it's going to lower their taxes, but you never know, somebody may just want to say, I want the thing paid off. Remember, folks, most people in the retirement planning world, this is a new field for them. They don't really understand the emotions and the psychology of a saver. They try to make it too much about the economic side, and sometimes economics weigh second. They don't weigh first. You got to keep that in mind when you're working with savers. Okay, looking at my cheat notes here. So based on this example, okay, we did a calculation. Our own TJ Timmy Reagan. I got to go get Juanita. Derek, I'll be right back. Timmy, thanks again for your help, man.
Is your name Timmy?
No, my name's not Timmy. I don't like being called Timmy. I've never been called Timmy.
Calculated this for us. And we're going to say, TJ, what we did, we said, how much can this person take out based on their current income and stay in this 12% bracket? And what TJ came up with is we can pull out of this tax-infested IRA. Again, we would manage all this, folks. You don't have to do any of this. This is what you're paying us a fee for. By the way, all these planning strategies come at no additional cost to our clients. In this example, we would need this in a Charles Schwab platform. We would charge 0.8% for the Charles Schwab platform, but we do everything. We calculate the taxes, get that money to you, lickety-split with no additional cost. So basically, by taking money out of the IRA over 5 years in an amount of $25,000 per year, in this example, based on the debt, we paid off the house, okay?
let's say it was $125,000. But this person in year one says, nope, Tony, I want to pay off that house and I need that $125,000 now. Now the problem is, what happens is part of this, and doesn't matter the percentage, but part of this is going to go into a 22% bracket depending on their current income and how much above the taxable income thresholds go. Again, put this graphic up, Aaron. You can see that real quickly, if we're not careful, it jumps from 12% to 22%. We call that tax bracket creep. So let's say roughly $100,000 went into the 22% bracket. Well, they're going to have to come out of pocket with an extra $22,000. Now, they could pay it out of savings, but if they didn't have savings, that means we're actually going to have to take out probably $150,000 to net the $125,000. So here's the point, folks. If you don't have a retirement planning firm truly working for you on these issues, huge issues of when to take out distributions, how much the taxes are going to be, how are we going to get the money, and where are we going to pull it out from, this is all we do at Tony Walker Financial. So if you're retiring soon, maybe you're looking at possibly an old 401k, maybe even just received an inheritance or sold a piece of property or sold your business, and you need a well thought out game plan that you can count on to take you through retirement, we need to talk. And we've made this easy to do. We call it the free fiduciary phone call. So to take advantage of that, log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com, and just click on that Let's Get Started button.
Tony, I know you recently wrote a best-selling book that's called Live Well, Die Broke. I have to admit, that is not exactly something I would expect to hear from someone who's giving retirement advice.
Well, that catches people off guard because, don't I want to have all kinds of money? The whole purpose of the book was to remind people that you have to spend this money before it's too late. What I've seen over the years is people don't do that, and whether they want to admit it or not, everyone dies broke. What I mean by that is, Diane, you can't take it with you. So it's interesting that people work so hard to save all this money, but nobody's encouraging them to spend it. Now, here's the reason I believe the financial world doesn't want you to spend that money. If you start taking money away that you've saved with the financial world, that's less money for them. That's less commissions, that's less fees, et cetera, et cetera. Everybody makes money on your money if you don't spend it. The moment you start spending and enjoying that money is when you would get to enjoy the fruits of your labor. So if you think about it that way, you've worked hard to spend it, and at some point there'll be a point in time where you can't. A lot of people we have are getting older. They don't spend any money. I mean, we have people spending a couple $1,000 a month, and they come in their 80s and go, Tony, what am I supposed to do with all this money? Well, they couldn't even spend it even if they wanted to. They're not doing traveling and doing a lot of things they did when they're younger. So I think the philosophy is right on. I think it makes complete sense. And when our clients see how that we can make sure they use and enjoy and protect that money, and then show them how they can still use it without running out of money, it's a game changer, and it liberates them to feel like they can enjoy what they've worked so hard to save.
That makes sense. And you're dealing with savers. So that mentality, maybe you're having to mold it a little bit for them.
You're right. A saver, that goes against the grain. They've saved money. They're not good spenders. But we'll make sure they enjoy that money. And again, we'll make sure they spend it without running out of it.
For additional information and scheduling your free, no-obligation appointment, go to TonyWalkerFinancial.com.
Welcome back to the Worry-Free Retirement. Tony Walker here, and I'm with Mr. Trey Juergens, Chief Compliance Officer. I know at the break you said, can you please mention that, Tony? No,
yeah, I'm all about titles.
Chief Compliance Officer and fellow fiduciary here at Tony Walker Financial. In case you're just out joining us, we are talking about this whole idea of housing costs and all the articles we've accumulated and just this predicament that people find themselves in, mainly savers, of retirement. Whether it's parents that you have, I don't know why, excuse me, I just thought of this. Remember the scene in Gran Torino? Remember when Clint Eastwood, his son and daughter-in-law bring over those brochures
Yes.
on the assisted? In fact, play a quick clip of that, Derek, where he gets aggravated. Actually play the clip where they're talking to him about how wonderful the assisted living facility is. This is a classic.
Yeah, no, there are these great places now, these communities where you don't have to worry about mowing the lawn or shoveling snow, where, the people are like you, active and alert, but are alone and would benefit from being around folks their own age.
Oh, yeah, Dad, look, you got to check it out. We brought some brochures.
But I mean, we laugh about that, Trey, but these are real issues. In this example, Clint Eastwood was a widower. His kids were concerned about him. They're just trying to be of help, and he didn't want to move out of this house. And it's interesting that he already had a small house in Gran Torino, but let's take somebody that has a decent-sized home, and let's say things are going great. Maybe they're still married. Maybe they're widowed. It doesn't matter. And they're thinking, well, let's just downsize.
Yeah.
What's the potential problem with this so-called downsizing?
We see this a lot, and I'm here in the Louisville office, and right now in Louisville, the housing market is crazy. So what we typically see, if you are to downsize, that doesn't necessarily mean down cost. It may make your life around the house a little bit easier, but when it comes to the cost of housing, a lot of the time you're going to be spending more to get in a smaller house. And I think these adult children really want to help the parents make their life easier, but in terms of their monthly cash flow, it might not necessarily do that.
Well, and again, and we're not suggesting any particular type of living dwelling out there when I say this, folks, but even these patio home communities, which I think are really cool, but a lot of them come with those HOA fees, and those HOA fees are not guaranteed to stay where they are now.
No, that's when we see the condo fees, HOA fees, part of that downsizing. You're paying for these things to be taken care of around the community, and they kind of hold the keys to what those costs are.
Yeah, I met a client recently, and they live in a large condominium unit, and they were talking about all the decks that extend out from that were built years ago. And they said, our deck's fine, but guess what? A lot of those decks are falling apart. Well, they got a quote to replace all the decks, and they're going to have to assess everybody. It is a big number. And they're like, man, we didn't have any idea we're going to have to pay for this kind of stuff. The other story I had to share on this, now this kind of ties in with downsizing, but folks, this is the HOA fees. And what worries me just a little bit, again, we're not telling you to avoid a place that has HOA fees. To me, they make sense on the surface. But I had a buddy, I used to see him at a conference a lot. He was a financial advisor. And back during the early 2000s, I don't know if you remember this period of time, Trey, but Destin, Florida was going crazy.
Yeah.
So he bought a huge condo and a high-rise down there, paid right at $1 million for it. He put $300,000 down. So he borrowed $700,000. So from a debt to equity, that's pretty good, right?
Sure.
I mean, He thought that's fine. Well, all of a sudden, 2008 hit. The market crashed in Destin. Values plummeted. Now, here's something he had never thought would happen. People start moving out and selling. So you say, well, what's the big deal, Tony? Well, okay, I'm just using math here. Let's say there were 500 people in this humongous high-rise. It gets down to 200 people. Well, folks, those HOA fees, all that maintenance, all that has to still be paid. So they divided up the same amount of expenses to run this big, huge place among 200 people. His HOA fees went through the roof, plus the values plummeted. And he told me, he said, Tony, I went into my banker and threw the keys on the desk and said, it's yours. And I walked out. And he just turned it. So, folks, we're not trying to scare you at all, but these are huge decisions, and decisions you shouldn't take lightly. So if you're that person right now that's on into what I call the second half of life, and you're concerned about where you're going to end up living, maybe you realize, hey, this isn't my permanent home after all. I may have to move here or whatever. Or we're seeing more and more of this. You're an adult child, and you're concerned for your parents, and you're trying to have just that conversation about, Mom or Dad, what can we do here? And, I would encourage you, and we've done this on several occasions, it's happening more and more, Trey, the idea of the family coming in. We don't mind meeting with the adult children and the folks that are in question in terms of possibly moving. Tell people how that process might play out.
Yeah, sometimes we have up to 3 adult children in the office meeting with that client and just really kind of having an ability to really dive into what they want, what the children are looking out for their parents for, and how we can help them in coming up with an income plan to pull that off.
Yeah, we recently went through that, and we gave some really good suggestions, I think. And the elderly couple who was in question here, they said this makes so much more sense. And they ended up following through on our recommendations. I won't go into the details of that. They had all the adult children, who most of them had been in this meeting, to their house, and they literally threw a party over the decision they made because everybody was now on the same page, and deep down, everybody was concerned about this. So, folks, maybe that's you right now. If you have an aging parents, or maybe yourself, you're in that situation, or an adult child, give us an opportunity to talk. Just log on to TonyWalkerFinancial.com, TonyWalkerFinancial.com, or give us a call anytime at 877-499-9255. Well, we're out of time today, but we hope you've enjoyed the Worry-Free Retirement. But you remember, between now and next week, if all else fails, you be worry-free and make it a good one.